Hi traders, in today's video we are going to look at how to trade smart money concept like the banks and the 5 solid rules you will need to implement in your trading plan. Basically, this might be the only video you need to trade like the banks. So without wasting time, I'm going to go straight to the rules that you need. The first rule is your market structure. And what are you looking for here? You are looking for your directional bias, okay? And also, what form of market structure are you looking at? We have two, okay? Two form of market structure: continuation and reversal. Continuation and what? And reversal. Okay? Continuation and reversal. So in the continuation pattern, what we'll be looking for is simply a break of market structure in the original direction. For example, here we have a break here, then we are going to look for another break and identify our point of interest areas where we are to buy the market. Since we know it's a continuation trade, okay, we have to wait for price to come back and tap into this before moving. How can we position ourselves to jump into a trending market? That is where you understand market structure in the continuation play. The other one is also, how do you understand market structure during reversal? When the market wants to reverse, what and what are you going to look at? Like in this case, a break of market structure to the upside from a down move. We have a break here. We have a break here. Break of market structure here. So why do you need market structure? You need market structure to know the direction. That is to build your directional bias, and the directional bias will be done from the higher time frame. So the first one is to identify a continuation break of market structure. This is the Euro USD daily time frame here. So we can observe that we have a continuation here, a break in market structure from a high to a low, from this high to this low. So we have a break of market structure here. And secondly, we'll be looking to sell the market when it gets to this point here. You identify your point of interest, okay? So your first goal is simply to identify your directional bias. So as the market breaks structure, you know that whatever you're doing, you're going to be selling the market when price gets back into this zone. Why this zone? Because this is the zone that that broke the structure. Supply was introduced here to break the structure. Okay, so once you identify your market structure, okay, be it a continuation pattern or a reversal pattern, like in this case, the next step is to understand what is called liquidity. And what is liquidity? Liquidity are simply pending orders, okay, on the chart. You identify where you feel that pending orders will be lying so that market moves towards them, because liquidity is what really drives the market. A market without liquidity will not move. Nothing will move. It won't go up, it won't go down. So like the algorithm in the market engineers liquidity, okay, and induce buyers and sellers to trade. For example, you can engineer liquidity and create areas of support and resistance. That means retail traders will be coming in here, and what are they doing? They are trading this region and providing liquidity for the market to move up or down to the desired direction. So liquidity is very important. If you don't understand liquidity, I did a video sometime back check the card up here or the description below, and you understand more on liquidity. So the second rule you need to ask yourself is there liquidity in this market? Now, we are not going to enter at this higher time frame, okay? We will move to the lower time frame, let's say the 1 hour, for example. Move to the 1 hour. So you can see that before we get to this POI, this is the POI here, the blue box. You notice that there's what? Liquidity. What is this liquidity telling you? Liquidity is telling you that this point of interest have a high probability of moving downwards. That is, when price getting here, there is a high probability of this price to go down. Liquidity. If there's no liquidity and price move in this manner, this point of interest may not hold. So what you need to do is you can refine the point of interest. You can refine the point of interest to this area here. You can refine the point of interest to that area. Okay. These are areas where supply was introduced in the 4 hour time frame, in the 1 hour time frame, sorry. So what makes you have confidence in this is because of what? It's because of the liquidity here. Liquidity. Number 2, is there liquidity? You take yes. Okay. The first check is this. There's liquidity, there's market structure. You understand your market structure. You understand your market structure. You understand that there's liquidity. You take it. Okay. The next rule is to identify your area of what? Interest, which we have done alongside liquidity. Okay. When you are trying to understand the liquidity, you must also have in mind that we have a point of interest. So in this scenario here, when price was all the way down here, okay, if we were to trade this particular point of interest, we understand that this is where the origin started from, and this is an area where we'll be looking to sell the market. So what the market has been doing all this while is that it engineers what? Liquidity for this point of interest. If you have a point of interest without liquidity, it has a lower chance of what? Succeeding. So what you need to do is to wait for price to get in. You don't need to execute the trade here. If you do that, that is a high risk entry. I will do a video and explain high risk entry and then a confirmation entry. But what we are looking at is what? We are waiting for confirmation, which leads us to the what? To the fourth. The fourth rule here is what? Confirmation. And how do you do confirmation? You are simply going to a lower time frame, okay, to make sure that the lower time frame is in agreement with your higher time frame. Lower time frame is in agreement. Lower time frame is in agreement with what? Higher time frame. That is your confirmation. Okay, nothing more than that. We have here lower time frame is in agreement with higher time frame. Okay, that's all. Meaning, if we are to trade continuation here, and let's assume this is your point of interest here. Let's assume this is your point of interest. Let's reduce this. Okay, what you need to do is you wait for price to get back in here in the lower time frame. Okay, now in the lower time frame, you wait for a bullish break of what? Market structure. When you confirm a bullish break of market structure in the lower time frame, you now understand that both the higher time frame and the lower time frame are what? Are bullish. There was a break in the higher time frame, bullish, lower time frame, bullish. Then once you confirm that, you identify another point of interest here. It could be here where you are going to trade from, and in this case you can use your pending order Okay, you can use your pending order to execute that trade. So what you need to do is to wait for price to get in here, then take price high. Okay, let's check on the this region on the 5 minutes, or let's say 3 minutes. So moving to the 3 minutes here, okay, moving to the 3 minutes, we can observe that when price was approaching this, that's one reason why I say you should not trade at the touch, because you can see that it went a little bit higher before coming down. So what you need to do is to look for a break of structure, and that we can see here. I have a break of structure here. Okay, the last low that took out all the liquidity here, because there are serious orders pending here. So this last low took it out. When price came below it, you then identify where you'll be selling from. Okay, most times you can sell from here, then the high will be above this, the high will be above that. Okay, then also take note of the origin, as well. This is done if you want to re-enter the trade. Okay, maybe you want to add up to your position, also take note of that. Okay, so in this case here, this is our confirmation here. Yeah, the break of market structure here, meaning the higher time frame is bearish, the lower time frame is also what? Bearish. So you can take your short tool and then place it there, allow price to do its thing. Allow price to do its thing. Then the last rule is, when you enter the trade, where are your targets? Okay, first you can target the origin here. When you target the origin, you have a 4 to 4 hour. If you enter here, okay, and you allow price to play, the last one here is simply number 5 is your target. You should have a target. Okay, so far we have market structure checked, liquidity check, POI check, confirmation check. Then the last one is what? Your target. So you can target on the time frame where you, first of all, where you take your entry, take your target here, but don't take all. You take some of the profit so that you know you are risk free. Then you now go back to your 1 hour chart where the setup took place. Now here on the 1 hour, you can see that we have imbalances here, imbalance price action here. So your target can go all the way down, to this, to fill up this imbalance. Okay, and if you understand your liquidity concept very well, you can also go to the 4 hours. When there's a break of structure, you expect price to continue going down to break this low. Okay, to break this low, but you take profit along the way. Okay, no, I don't think anybody can hold this position for 100% till it gets here. Okay, you take profit along the way. So this is simple trading plan that you can have in terms of what? Rule-based system. You first of all wait, is there any market structure break? In what direction? If it's bullish, you take note of that. You look at your lower time frame, is there any liquidity that will make my order, my point of interest valid? If there are liquidity, you take that. Then the point of interest, liquidity and point of interest should go hand in hand. Okay, you don't want to pick point of interest in isolation. You must attach it with liquidity, because when you attach with liquidity, it makes that point of interest a high probability point of what? Interest. Then you don't just enter at the touch of the point of interest. You wait for a confirmation. Okay, and the confirmation is simply your lower time frame is in agreement with the higher time frame. Okay, then your target, you use what areas of what liquidity as your target. For target, you use what area of what liquidity as target. To learn more on liquidity, the next video that will play after this will be about liquidity, so you can watch that video and have a proper what understanding. And if you are here and you are yet to subscribe to my channel, kindly do that. Hit that subscribe button, like this video, turn up the notification so that when I release a content just like this, you will be the first to know. Also, show me some love in the comment. Let me know your takeaways and what kind of video you want me to do in the coming future.